and welcome to today's segment of The Power of Money. I'm your host, Michelle Graves, affectionately known for the last 40 years as the Money Lady. And as always, my commitment is to bring you information, introduce you to phenomenal people in my industry, financial services, and give you tools and keys for you and your family to prosper during these very, very challenging times. It's imperative that all of you spread that word to your friends and family that this show is committed and has been for over 2 decades to doing this. I am a proud member of DATV in Dayton, Ohio. And again, we broadcast this show not just on YouTube, but we broadcast this show in 54 markets and soon to be 55. First of the year, I will be crossing into New York City, Manhattan, with this same agenda to empower people throughout the United States. Today I have as a continuation of my last interview with Scott Bradley, who is actually an extraordinary man, incredibly knowledgeable in his chosen profession in financial services. We were talking about annuities and we ran out of time. And that's too important of a subject today to not go deep. For many of you that don't understand annuities or don't know what types of annuities are about today, he is your man. And that's why I invited him to come back on the show so that you could get the information and ask the questions in your mind. Email me if you wish. I'll route them on to him or call him direct. It's up to you. But again, Scott, how are you doing today?
We're doing great. And first and foremost, thank you so much, Michelle, for allowing me to chat with you and your viewers today, because the information I've got is very, very, very important, or at least it is to the average consumer that wants to enjoy retirement and enjoy their retirement fund.
I think
And
that's
one
an
of,
important.
go ahead.
No, I think that's important. People are fast moving into retirement. 10,000 people a day are coming out of the workplace and going into the final part of their life, hopefully the best part of their life, where they have freedom to live as they choose. So let's talk about that and let's see what you got to say.
Okay, there's several things I'd like to go over here. All right, and I'm just going to delve directly into it. I'm going to talk about what an annuity is, number one, and number two, what it can mean to someone during their retirement year. I think the major question people have is because there are some large companies that have millions and millions of dollars to spend on advertising that have given, I call them half truths. In other
Yeah.
words, they haven't given the full story as to what's available to the individual. Now, I'd like to back up just a second and go with you through the process that I find to be most beneficial to your listeners and understand exactly what a good financial planner should do. In many cases, I find that when someone is a financial planner or has many, many degrees behind their name, they're more interested in quickly selling some kind of product or some kind of program and then moving on to the next person. Typically, it is so important to understand where someone is coming from. And what I mean by that is, what's their hopes? What's their wants? What's their needs? What's their desires? What makes them tick? And what keeps them up at night when it comes to money? All right. Again, I've been doing this for well over 30 years, and I have found something consistent with every person that I've talked to. During my initial interview or discussion I have with someone who is interested in some type of planning, I discover that their number one fear that they have is running out of money.
Yeah.
And in other words,
Yeah.
when they retire, they're more concerned with running out of money versus anything. Now, why would they have that kind of fear? What would cause that kind of fear? Well, two things. First of all, there's myths, or in other words, they've heard somebody saying something that was not in the financial field and caused them to get scared. That could be the first and foremost that they have as a concern. The second thing is they're worried about losing money. That is another major concern that they have. They don't want to lose any of their retirement money. I mean, let's face it, if you've worked for 40 plus years and you've built up some type of retirement, whether it's a savings plan or 401k or a pension or some type of retirement program, you are almost like a deer caught in the headlights because you don't know which way to turn or understand what is available to you. All right? Now, I have been in the past a stockbroker, a money manager, a registered investment advisor, and done all of those jobs in the past. I am no longer a stockbroker. I'm not a registered investment advisor, and I'm not a money manager in any way whatsoever. And why did I leave that business? Because two things. Number one, the risk was much more than I was comfortable with for my clients. Okay. And secondly, I was restricted and I was pressured by the companies I worked for to sell a certain product which might not meet an individual's needs. Now, when I say that, I say it because when someone tells me their needs, their wants, their fears, their desires, all right, that doesn't necessarily meet up with the programs that I used to sell to people, such as stocks, bonds, mutual funds, and risky investment. I'm a very conservative person, all right? I'm 64 now, and my thought processes or my way of thinking about money has changed over time. I'm very conservative. I hate to lose money. I
I
hate
do
it.
too.
Mhm.
I do too.
And I don't want to take any risk whatsoever. But on the other hand, if you don't take any risk at all, then if you're listening to the money managers, you're not getting any returns on your money. And frankly, that is not true. All right. And I want to share with people a term that we've mentioned called annuities, and I want to tell you exactly how they work. Annuity is a fancy term for taking a big pile of cash and turning it into monthly or annual or semi-annual payments to you that you can live off of. All right. Well, what's the difference between having a regular pile of money in the stock market, for example, and what I've just described to you? In the stock market type, there are no guarantees with your money. In other words, it's going to fluctuate up, it's going to fluctuate down, it's going to go sideways. You're not guaranteed what you're going to get. With an annuity, you are offered guarantees that your money will never run out. All right? Meaning, you can eliminate the fear that you have when you retire. Hey, is this lump sum of cash that I have here going to run out? And using a strategy with annuities, right, it won't. It will never run out. You'll never be able to, as long as you're living, right? And if your beneficiaries are set up well, in other words, you've done some planning and made sure that they're set up correctly, that income can also pass to your beneficiaries as well. And here's the good thing. There are ways to set up your portfolio so that you can take advantage of what the stock market does, but at the same time, if the stock market decreases in value, in other words, goes down, right, your money can be protected on the high end, all right? That's the best of both worlds. That's how people can set up their portfolios to make certain that they don't lose money. So, as I mentioned to begin with, the biggest fear that people have was number one, running out of money, and number two was the potential to lose money. That scares them. And why would that be a big fear? Because when you were working and when you were building your portfolio, all right, if the stock market took a downturn, you had one thing going in your favor. You had time to make it back up so that it would gain in value. Does that make sense?
Yes, it does. Yes, it
All
does.
right.
It makes a lot of sense. Okay.
But once you turn, and I'm just going to say age 65, okay, I'm 64, all right? So I'm right at this verge. I'm right at this time frame that we're talking about. What is the one thing that you don't have excess amount of?
Time.
Time,
Time.
okay?
Time.
In other words, if you had your money in the stock market and it took a downturn, a major downturn, right? What do you need to recover your money?
Time.
Time. And you don't have much,
No.
right?
Right.
Right? So here I look at all these different ads. Like one of my favorite shows to watch is 60 Minutes, and every other ad on 60 Minutes happens to be a large money management firm that particularly doesn't like annuities and wants people to move their money to them. And frankly, they're in the stock market, they're in the bond market, they're actually putting people's money at risk when in fact they could be going to a more conservative and safe investment through annuities.
Can I talk?
Right?
Can we shift camera? Because I'd like to talk about this issue of safety, particularly given what we are now. I believe we're transiting into another economic um, economic peril. I mean, the bond market, global wars. I mean, we've always had wars, but now we have what is emerging as a big war, not just between Ukraine and China, and it's just awful. And we're looking at the printing machine called the US government and our debt and our inability to find solutions. Um, how does an annuity address that issue, the type that you've described? And I hope you go into the other types as well, but this particular annuity, I believe it's an indexed annuity.
That is correct. Yeah.
Okay. Tell my viewers how that protects them.
Well, first of all, there are several kinds of annuities that are available out there. All right. The first one that I had mentioned to you was something called a variable annuity. With a variable annuity, it is attached to the stock market, and there are no guarantees with a variable annuity. In other words,
Okay.
you can lose money. All
Okay.
right. That's first and foremost. I need to tell you. The second type of annuity is what's called an immediate annuity. That's where you take a lump sum of money, like a pile, what you've built up, okay? You transfer it to an insurance company, and then that insurance company says, okay, you have just given me X dollars. What we are going to do is convert those dollars into monthly payments for you starting the next month. That's called an immediate annuity. The drawback with that is that you no longer have a lump sum of money. You only have those payments, whether they're monthly, semi-annual, or annual. So that's how you have your money tied up. The next type of annuity is what we call a fixed annuity. A fixed annuity is very, very similar to a CD. You go to a bank and you get an interest rate, and they give you X percentage over a certain number of months or a certain number of years. I'm sure everyone's familiar with that type of program. That's called a fixed annuity, right? And then the last annuity that I'm going to talk about is something called a fixed indexed annuity. This is a hybrid of all the annuities put together, meaning it is linked to an index, meaning your money, when you transfer your money to the insurance company, it is linked to an index. And that index could be the Standard and Poor's 500, it could be the Dow Jones Industrials, it could be any number of indexes across the marketplace. And what the insurance company is saying, right, if you put your money with us, right, we will track your money according to how the index does over a period of time. And typically that's either 1 year or 2 years. And we will give you a percentage of the return that that index made. In other words, if you started out with an index, and I'm just going to make up some numbers here.
Okay.
Right?
Okay.
If the index started on January 1st at 1,000, and that's when you went in, all right? And at the end of the year, that index is 1,100. That means that index would have gained 10%, all right?
Got it.
So the insurance company looks at that and says, okay, that index did well. It did 10% return during that year, all right? We are going to pay you a portion of that index. In other words, that 100-point gain there, right? We're going to credit that towards your account. Well, at the same time, again, we go back to January 1st, and the index was 1,000, all right? And at the end of the year, instead of it gaining in value, it was negative, and the index was 900 instead of 1,000. That would typically mean, in most people's minds, that they would have lost 10%, right?
Right.
Okay. But the insurance company says, no, we are going to go ahead and continue to credit your account as if it didn't lose any money whatsoever. All right. Now, you're saying to me, well, wait a minute. I put in money, all right? I left it there for a year and I didn't make any money. All right? That's not a good deal, is it? Well,
Depends.
actually it is.
Depends.
Wait.
Right.
It is a very good deal because what didn't happen? All
You didn't
right?
lose any money.
Your money did not decrease in value at
Right.
all.
Right.
Right? When everyone else who was in the regular stock market indexes, they lost money, didn't they?
Yes.
Okay? So there is a saying that not many financial advisors talk about, and I want to mention it now. Zero can be your hero. And what I mean by that is, all right, if the market goes up and you take advantage of the marketplace and you get a good return on your money, that's great, all right? But on the other hand, if the market happens to go down in value, all right, your money, all right, did not lose at all. In other words, you got a zero return. So zero in that case
Is
can
your
be
hero.
your hero.
Can we talk about that, because I had a situation not too long ago, and I say this, the zero is your hero, where an individual was frustrated that they had not made really phenomenal returns in the market. And I said the same thing. I said, but you didn't lose any money. What's wrong with that? Well, I expect to make money. Oh no. Oh no, no, no. That's not the way it works. If the market is trending down and people are losing money and you're not losing any money, you're just floating along, what's wrong with that? So what would your response have been to that type of a concern?
Well, there's two ways I'd like to tell you. First and foremost, there are no guarantees in life. There are only two guarantees, okay? One, that we're going to pass away one day, and the second guarantee is you're going to have to pay taxes.
Yes.
Right? And
Uh-huh.
everybody laughs about that, but it's so true. All right. And with a response, I would like to share with you a story, what happened to me back in 2007 and 2008.
Woo!
I had a I had a
Yes.
client who was named Mary. All right. And when her statements would come in, I would always go and review their statements with them. All right. So in 2007, her statement came up, and I called Mary and I said, Mary, can I come visit with you? I'll go over your statement. I'll share with you exactly what it means. She says, yeah. So I go to Mary's house. I get in there, and I was really, this is 2007, I was kind of excited, and I told her, Mary, you got a 13% return on your money. In other words, that's pretty good, all
Yeah.
right? If
Yeah.
you getting 13%, that's absolutely wonderful. Mary sat there with the most, she looked at me and she was mad, okay? And it was blowing my mind. I'm going, Mary, I just showed you a 13% return on your money. You should be happy, okay? Yeah, but I didn't get what my neighbor got. She got a 34% return on her money, and I think I got ripped off because I only got 13%. I said, sorry, this is safe, this is secure, and you're getting a good return, all right? So let's fast forward another year. 2008 comes around.
Oh.
And just for a reminder of 2008, the stock market dropped approximately 40 plus percent in that year. In other words, it went straight down. All right. So here I get another statement from Mary. All right. And it's got a 0% return on it. She didn't lose a single penny. All right. At all, but she didn't make any money on her money. All right. So I am absolutely dreading going to see and visit with Mary. I just didn't want to do it, all right, but I did, all right. So I go and knock on the door, and Mary answers and everything. And when she comes to the door, I could smell she had been baking, all right. And she says, "Wait a minute." She brings out this big pile of brownies and said, "Do you like milk?" And she brought milk out and handed it to me. I'm flabbergasted. I have no idea what's going on. Mary is just as happy as can be. And I'm going, but Mary, you didn't make any money on your money last year. Like that. You know what her response was to me? Yes, but I didn't lose over 50% what my neighbor lost in their money. Okay? So, in other words, the moral of the story is that zero can be your hero because you're not losing any money if using some of the things that we're talking about. Now, I'd also like to go into the conservativeness and find out, and this is what a good planner does with each individual. There is something called a fact finder. A fact finder means that the client or the prospect will share with you their financial information. All right? You find out what they've got, where they are today, all right? And then figure out what can be done with that money. In other words, I can't just turn a switch and make money, all right? I have to work with what they already have, all right? And during that time frame, it is very important to find out. Again, I talked about needs and I talked about wants. Those are two separate items, okay? Needs are what you need day to day to make it, to live, right? Wants are you see something flashy or you see something that looks nice and that's what you want. And I hope that makes sense, right? Because a good financial planner in using strategies with annuities can set up a monthly or a semi-annual or an annual income that never drops in value and never goes away. Right? And it can be set up in such a way that they don't have to be concerned that they're going to run out of money because it never does. Again, there's a saying that happened. Annuities have been around since the mid 1800s. Matter of fact, they can be traced all the way back to Roman times, but here in America, they've been around since the mid 1800s. And what they were designed to do was to ensure or guarantee that the average worker could make certain that they received an income to keep their style of life the way it is, right? And that's the easiest way that I can put that, right?
I
Uh,
think if I might interrupt, that's extremely powerful information that you've just said. And that is that it was put into place in this country to make sure that people did not outlive their money. And
that's right.
of course there are other benefits. I Let me just say preferentially, Scott, I've done trades. I have been on Wall Street. I have handled billions of dollars of investable assets for corporate clients. And I will say to you that insurance companies do not have an issue around that type of a product because they got to pay out premiums too. You know, when people die, we have to meet those obligations. And I'm saying that because I did manage an investment portfolio for a major insurance company. The typical person, though, I think has not been exposed to what they are, which is why I wanted you back on, and how it is important. And viewers, hear me from my heart. The worst time to run out of money is when you are older.
That's
You,
right.
you, you can't believe people are working at Walmart at 80 because they want to. Things have happened with their resources, and therefore they have come to that. And this is simply a vehicle that has been around, that is, again, when you can't be in that situation, here is your answer. So I just wanted to say that, Scott, I appreciate as you're sharing, and please continue. But I wanted to tell people that when people tell me at 70, well, I'm in the stock market and blah, 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 and I'm like, why? Well, my broker, why? Forget that. I'm talking to you, why? So, as you were saying,
Well, I want to go into something. You have opened up almost a bag of worms here, all right?
I know.
And and you know exactly where I'm going from them. But I need to go back to basics for just a second, all right? So people get into an area where they feel very confident if they take their money and they put it in a bank, for
Yes.
example, all right? Now, I'm going to refer back to the Great Depression, and I'm going to talk about what happened in the Great Depression. See, a bank's whole system, all right, is based upon debt and loaning money out. In other words, you need a loan, where do you go? You go to your bank, right? What happens is if you have $100, right, and you put it inside a bank, all right, a bank only has to keep as little as 10% of that money in reserves. In other words, your $100, they only have to keep back 10, all right? And they can loan out $90 on your 100 to others, all right? And what happened during the Great Depression was that there was a run on the bank's monies. Right? In other words, people went to the bank to get their money, and there was no money there for them to get. All the bank owned were all these debts from everywhere across the country to get that. And it got into a spiraling effect, and that's why so many banks went under. All right? Hence, all right, the FDIC was created. It was created, I believe, in 1934. And what was that designed to do? It was designed to give people confidence in their banks. But people think that that's the U.S. government that's going to take care of them. It isn't, all right? The FDIC stands for Federal Deposit Insurance Corporation, All right. That being said, all right, let's talk about what happened during the Great Depression in the 20s. All right. Insurance companies do not loan out money, all right, as a rule. They don't. They will loan you, and there are certain tax scenarios you can get into, which I'm not going to cover in this, but under 98% of as a rule, insurance companies do not loan money. They are based upon cash, all right? They have to keep certain minimum guarantees in reserves to meet their obligation. And those obligations are the various insurance contracts that they have out there. Why I say that is during the Great Depression, insurance companies did not go under. They actually flourished. And why did they flourish? Because they had cash to back up everything they wanted to do, and they were able to literally purchase and grow in value during that time frame. Right? Now, when people get concerned about protection of their money and what is available, annuities are only issued by insurance companies. The reason that insurance companies have been able to support and been able to be so safe and secure is just what I mentioned. They're based upon cash, they're not based upon debt. You see, in the history of annuities in the United States, no one has lost a single penny having an annuity. That's a very strong statement.
Yes, it
Because
is.
if we look at banks, banks cannot say there have not been failures of banks and that people have not lost money because they have. All right? Insurance companies are the most safe and secure and conservative way for your asset. Then the next thing you're going to ask me, and I know it's coming, they're going to say, well, do you get a competitive return on your money? In other words, do you get a competitive income? There are literally ways to structure your annuities so that every couple of years you get an increase on your money that you're getting every single month. And that can be set up very, very simply. And I'm not going to go into the specifics on how that's done, all right, because it's a fairly lengthy and very it's difficult to set up or difficult to explain on a short time that we have, okay? But it can be done. So you need to understand that. In 34 years that I've been selling annuities, right, I have yet to have anyone come back and complain that they don't have enough money or they're running out of money because I've set them up in such a way with good planning that their needs are met and also some of their wants are met with the fund they're getting. I have a client right now, it's in Iowa. I'm in South Carolina, right? And they're in Iowa, all right? And they're calling me saying, Scott, I know we talked about income coming in. Now I've got excessive income. What do I do with the extra money I've got? And I said, take a vacation to Florida. Do what you
Yes,
want to do.
whatever you
Go to
want.
Hawaii. Do whatever
Whatever
you
you
want to
want.
do because you deserve it. Don't feel like you've got to hoard or the money's not going to be there tomorrow. It is, all right? And we have set you up in such a way that you can live how you want to live. And that's the benefits of annuities that are not being shared on those multi-million dollar advertisements on, CBS, NBC, etc. Okay, that it is there to make sure that you never run out, you are not concerned any longer, and the amount of stress relief that happens when you work with someone that is fully explaining or understands what annuities are. Now, I also want to address the number one thing that is used against anyone that sells you an annuity. Okay? Oh, they make so much money if they sell you an annuity. All
Not
right?
true. Nope.
Let me explain that how that works. All right? At the very beginning of our conference today, we talked about one product. It's called a variable annuity. All right? A variable annuity, if a stockbroker, you have to be registered with the federal government to sell those. All right? If a stockbroker sells that to you or a money manager sells that to you, all right, they are paid an ongoing commission. In other words, every single year that you have that, they're paid fees. The second thing is your fee comes directly out of the variable annuity. It's your money that you're basically paying to the money manager. Just, are you familiar with that, aren't you? I mean, you
Absolutely.
understand what
Oh
I'm
yeah.
saying. All
Oh
right.
yeah. Oh yeah.
Now, let's talk about an annuity that's issued through an insurance company, such as a fixed annuity or a fixed index annuity or an immediate annuity, something of that nature. All right. The insurance agent that sells that to you is paid a commission directly from the insurance company, not from your money. It does not come out of your money. In other words, if you put $100,000 into an annuity, your first statement coming to you is going to say, you have $100,000 in your annuity. There's nothing coming out. Versus if you have a variable annuity and you put $100,000 in it, your first statement coming to you is going to have a reduction in all the fees and commissions and expenses out of that annuity, so you will no longer have $100,000. Does that make sense?
It makes perfect sense. And you know what? Thank you for giving that clarity. And the reason I say that is because most people don't know that. They do not understand how that works and why. I mean, in the brokering industry, I mean, they get really, really fried when you start talking to them about fees, commissions, and then annual. Don't neglect annual,
Sure.
because there's annual fees on that variable annuity.
On the variable annuity, typically, I know that I'm glazing over this, but typically a variable annuity, the first year that you get that, will have anywhere from 4 to as high as 6.5% fee when you
Yeah.
purchase it.
Mm-hmm.
Okay, that's the difference. In other words, if you put 100,000 in, they're going to take out $6,500 in
Right.
fees. All
Mm-hmm.
right, and you
Right.
will see that on your first statement. You will. But the worst thing that goes across is every single year that you have that, you're going to have what they call 12B1 fees, which are administrative fees. Okay. You're going to have commission fees, and you're going to have management fees for every sub account that they go into, which can add up to 3 or 4% every year going forth, regardless of whether the annuity went up in value or went down in value. It doesn't matter. You're going to pay those fees. All right. So that's why I do not recommend variable annuities to anyone I talk to. I do, however, recommend fixed annuities, fixed index annuities, single premium immediate annuities, and multiple year guaranteed rates. Okay, I really do recommend those to people because the fee or commission that you pay, all right, does not come out of your money. It is
Right.
automatically paid by the insurance company, all right? And year by year, all right, there are no additional fees coming out of your account. That is a big, big difference there,
I think it
okay?
is. I think it is. Mm-hmm.
Yes. And the only way that you would have a fee is if you bought something additional on your contract, such as a rider. All right. But that is totally optional, and you can do it if you want to, or you can do it if you don't want to. It just depends on your particular situation. Now, Michelle, I have done this for so many years, and I know that people are wondering how in the world have I continued to operate, because I'm in South Carolina, you're in Ohio, all right? But it's literally like we're sitting across from each other, talking to each other.
Yes.
Well, ever since the pandemic has hit, people are used to doing Zoom meetings or talking back and forth and conducting business in that fashion. I find that regardless of the state that you're in, or regardless of where you are across the country, I can still help you and meet your needs, or at least advise you on which way you should go with that. Period. I'm licensed in the majority of states, all right? And in the event you call me and I'm not licensed in that state, within 24 hours, I can be licensed in that state and have no problems whatsoever, okay? So that's not an issue to go for. I find that your reader, or not readers, your viewers, all right, are lacking good financial tools because of something called trust. Trust being is, does your financial advisor truly understands what your needs, wants, fear, desires, hopes, what keeps you up at night? What have you thought about? What makes you tick? Have they ever asked you the question, okay, you've been told that if you continue to take money out of your account, you're going to run out of money at age 78. Well, what will you do at age 78 if your money runs out? Are you going to go down to Walmart and fill out an application to stand there as a greeter saying, welcome to Walmart, for 6 to 8 hours on your feet all day at 78 years old? That's not what you worked 40 years to do. Right? And when you put things in perspective like that, and when you help people understand the seriousness of what they've got at age 65, all right, or it could be age 60, it could be age 70, it could be any period of time that they are retired, has anyone truly advised you as what you can do with your money safe and secure? Oh, one of the biggest things that I didn't even go into is leaving a legacy.
Thank you. Thank you.
Meaning, when you, and it's going to happen to all of us, nobody likes to talk about it, but it's going to happen to all of us. We're going to pass away one day, all right? And where would you like your retirement fund to go? Would you like it to go to a charity? Would you like it to go to your grandkid? Would you like it to go to your wife or your spouse, I should say? Or would you like it to go to your local charity of some kind? Or would you like to support a museum, or whatever you'd like it to be done with? And that's what an annuity goes without going through probate, without going through any process. A check can be cut to where you want it to go.
I
And
think
that's important.
I think that is essential as we talk about post-retirement planning, because the reality of life and longevity becomes more and more an issue. How do I want things to flow? And the simplicity, this is what, and I'm saying this, Scott, because I guess at a core level, I am extremely pro insurance companies. I worked for one of the world's largest. I worked for another management company that was huge in Europe. And my point being is that they have been doing this for a long time. And by their very nature, and regulations don't hurt, they are conservative. They are. When I managed that portfolio, there was no way I was involved in anything that was even sort of risky, because you were talking about millions and millions of people that were relying on your integrity in the marketplace. So I get it in terms of annuities and legacy and how easily that money can settle up without going through probate. And that's a real thing as well. So thank you for addressing that.
I think people do not realize what probate means. And in
Okay.
simple terms, I'd like to say what it means, okay? It is a Latin term, all right? And a Latin term means basically to prove, all right? So if your clients or your prospects have a will, okay, which everyone should have, by the way, and if you have a will in simple terminology, and I'm not an attorney, but I can explain it to you very, very quickly. A will is nothing more than a letter of instruction you write while you're alive to the probate judge saying this is what you would like to have happen. It is not by any means whatsoever a mandate that the probate judge does what is said in that letter. And on retrospect, if you have an annuity, all right, that is written by a life insurance company, there is something called a beneficiary that you will have to name. And I don't care whether that beneficiary, like I mentioned, is to a person or to a charity or to something that you want to have happen. When you pass away, all right, all proceeds from an annuity by law do not have to be probated. In other words, they don't have to go in front of a judge and they don't have to go for discretion. It's set in stone. When you pass away, this is what's going to happen with your money because you've already made those decisions when you were alive. All right? And that's the easiest way I can describe that process. All right? And by the way, that's why probably I am a fairly successful annuity person. I've written many, many, many over the years. And one of the reasons that I am successful doing what I'm doing is because I take a very, very complex subject and I have the ability to break it down to simple terms. Because I look at it this way. Can you, if you have a stock portfolio, or if you have a money management portfolio, or if you have a portfolio of stocks, bonds, mutual funds, warrants, options, and everything else, can you literally explain it? All right?
Yep. Yep.
Nine times out of 10, you can. All
Right.
right?
Right.
But if you have an insurance policy or an annuity, all right, can you explain that annuity very, very simply? Yes, you can.
Usually, yes, you
All
can.
right?
Yes, you can.
And
Yes,
I
you
think
can.
that's the big difference in the way that I go about things is breaking very complex subjects with my education and with my experience and making it so that my clients understand what they have. And that's the beauty of everything we've been talking about.
Well, I would like to also say that one of the things, and this is particularly relevant to our senior population, because so many of them, like it or not, wind up in nursing homes and other facilities. And again, without a clarity of understanding of what you have and don't have and how are things handled, the outcome again can be less than pleasant. And so I love what you're talking about with regard to this issue of simplicity of probate and the issue of legacy. We want to, I'm 71. I'm heading towards 72 next month. I want everything to transition smoothly. I don't want a situation where I'm having to, shouldn't say me, but my heirs are having to deal with portfolios and all this fancy stuff. It disturbs me greatly when I hear older people, and I'm not against you making investment decisions, but just be aware that we are in a deaccumulation phase. We're not trying to get rich at 80. We are trying to live a comfortable, stress-free life. That's the goal. We want to have fun because things are not guaranteed. So I think that what you're saying about the ability to explain things simply, easy to understand, are extremely, extremely important. and that our older population needs to be very well advised. I don't even talk to people anymore, Scott, who tell me right off the bat, oh, my stockbroker's got this going, blah, 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 blah. And I'm like, and what do you have going? You've told me about all these other people, but what do you have? Well, they're taking care of it. They're taking care of it, and I'm not worrying about it. What are your thoughts about that?
Well, that truly means two things, all right? Number one, that their stockbroker is a very good salesperson, okay?
Absolutely.
That they would say that type of thing to you. But the second thing is, I truly believe that their needs, their wants, their fears, their desires, their concerns have never been addressed with them. And so when I talk with the individual, and by the way, I'm a very low key type of person. I'm more of a consultant and educator than I am a salesperson.
I
I
agree.
truly believe that. All right. So when I talk with somebody, I'll talk with them 45 minutes to an hour specifically on what they want to achieve, not anything to do with my products or programs or any type of financial advice. I'm just trying to find out what they would like to achieve or what they want or what they've been told in the past that we can talk about. All right. That's first and foremost. So that's how I address someone who says, my stockbroker's got all that. Say, great. No problem. I'm not saying one word about your stockbroker because I don't know them.
No,
Right?
no.
What I am going to say, though, is what have you been told about your needs, your wants, your fear, your desires, your concerns? Have you been told that if you keep on the path you're keeping on, that you're going to run out of money? Have you ever been
Whew.
told that?
Well, you know
Right?
what, Scott? Because our time is up. But
I'm
you
sorry.
ended it, no, but you ended it perfectly because you said the road you're going does have an end. And can you give our viewers your telephone number, please, in the remaining
I'll
time we
be
have?
happy to give that.
Thank
My
you.
phone number is 864. Gosh, never dial myself. I forgot my phone number.
I understand.
I do that all the time. 864-907-0458. Again, that was 864-907-0458. I am in South Carolina, but if you call and talk with me, I'll be more than happy to chat and see if there's some ideas that we can share back and forth that might help you. Again, my name is Scott Bradley, 864-907-0458.
And
And so I'll be happy to help any one of your viewers.
And I thank all of you for listening in for this just immensely informative conversation about annuities. I'm sure you learned a lot. And that is the purpose of this show, is to enable you to thrive in a very turbulent situation right now. I'm Michelle Graves, affectionately known for 40 years as the Money Lady. And I thank you so much for being a part of my world and Scott Bradley as my guest today. God bless you, and we'll talk soon. Bye-bye.
Thank you.